Money has always been a part of human life. From trading goods in old markets to clicking a button on a screen today, the way we manage money has changed again and again. But something different is happening now. Something quiet but powerful is taking place. For many people, investing feels confusing and stressful. There are too many choices and too many opinions. One person says buy this while another says sell that. News moves fast and emotions move even faster. This creates fear, doubt, and hesitation. Many people believe that investing is only for experts. They think you need years of knowledge or special skills. They think you must watch the market every day. They think you need to take big risks to earn rewards. But this belief is not true. The truth is, investing can be simple. It does not need to be complicated. It does not need constant attention. And most importantly, it does not need stress. A new way of investing is rising, a way that removes confusion and reduces mistakes, a way that works quietly in the background. This is the world of robo-investing. Robo-investing is not about robots taking control. It is about using smart systems to guide your money. It is about letting technology do what it does best: analyze data, follow patterns, and stay disciplined. As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. This simple idea is at the heart of successful investing. But being patient is not always easy for humans. We react to news, we panic during falls, and we get greedy during rises. This is where technology changes the game. It removes emotional decisions and replaces them with logic. It builds a system that stays consistent no matter what happens. It helps you follow a clear path without getting distracted. Imagine a system that invests for you regularly. A system that spreads your money wisely. A system that adjusts itself based on your goals. And a system that keeps working even when you are sleeping. This is not a dream. This is already happening around the world. Bill Gates once said, "We always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. Robo-investing is one of those changes that will shape the future. It is already making investing accessible to millions of people. But technology alone is not enough. You still need understanding. You still need the right mindset. You still need patience and discipline. This book is your guide to that journey. It will show you how robo-investing works. It will help you understand the principles behind it. And it will give you the confidence to start. You do not need to be perfect to begin. You only need to take the first step. Because in the end, wealth is not built in one moment. It is built slowly through small, consistent actions. Now that you understand the shift that is happening, now that you see the opportunity in front of you, it is time to explore how this new age of investing really works. Let us begin with the foundation. Let us step into the new age of investing. Chapter 1. The new age of investing. The world of investing is changing in a quiet but powerful way. Not long ago, investing was limited to a small group of people. It required access to brokers, deep knowledge, and constant attention. Many people felt that investing was not for them. They believed it was too complex, too risky, and too time-consuming. But today, the situation is very different. Technology has opened the doors for everyone. What once required hours of research can now be done in moments. What once needed expert advice can now be guided by smart systems. This is the beginning of a new age of investing. In the past, investors depended heavily on human decisions. They would watch the market, read news, and react quickly. Sometimes they made profits, but often they made mistakes. Fear and greed played a major role in those decisions. When markets fell, panic took over. When markets rose, excitement led to overconfidence. Benjamin Graham once said the investor's biggest problem and even his worst enemy is likely to be himself. This simple truth explains why many people struggle with investing. It is not always about knowledge. It is about behavior. The new age of investing focuses on solving this problem. It reduces the role of emotions and increases the role of systems. Instead of reacting to every market movement, it follows a structured path. Instead of guessing, it relies on data. This shift did not happen overnight. It is the result of years of technological progress. Computers became faster. Data became easier to access, and algorithms became smarter. Today, these systems can analyze thousands of data points in seconds. They can identify patterns that humans may miss. They can adjust strategies without hesitation. And most importantly, they can stay consistent. Consistency is one of the most powerful forces in investing. It is not about making one perfect decision. It is about making good decisions again and again over time. Small actions repeated over years can create extraordinary results. As Albert Einstein once said, compound growth is the most powerful force in the universe. This idea is simple, but deeply important. When your money earns returns and those returns start earning returns, the growth becomes exponential. But for this to work, you need time and consistency. The problem is many investors interrupt this process. They enter the market with excitement. They leave when fear appears. They try to time every move, and in doing so, they break the power of compounding. The new age of investing aims to protect you from these mistakes. It creates a system that keeps you invested. It encourages long-term thinking, and it removes the need for constant decision-making. This is where robo-investing becomes important. It represents the practical side of this new age. It takes the principles of smart investing and turns them into automated actions. Imagine having a system that invests your money regularly. It does not wait for the perfect moment. It does not get scared by short-term drops. It simply follows a plan designed for long-term growth. This approach may sound simple, but it is powerful, because simplicity often leads to better results. Warren Buffett once said that successful investing is not about being the smartest person in the room. It is about having the right temperament, the ability to stay calm, patient, and disciplined. Technology helps you build that temperament. It acts as a guard against emotional decisions. It keeps your strategy on track even when the market becomes unpredictable. Another important change in this new age is accessibility. In the past, investing tools were expensive and limited. Today, many platforms offer low-cost solutions. This means more people can participate in wealth building. John Bogle believed that investing should be simple and low-cost. He emphasized that reducing fees is one of the easiest ways to improve returns. The new age of investing follows this idea closely. Automation reduces costs and increases efficiency. Global access is another major advantage. You are no longer limited to your local market. You can invest in different regions and industries around the world. This increases opportunities and reduces risk. Diversification becomes easier in this environment. Instead of putting all your money in one place, you can spread it across many assets. This protects your investments from sudden changes in any single market. Ray Dalio once said that diversification is the most important thing in investing. It allows you to reduce risk without reducing potential returns. In the new age of investing, diversification is often built into the system. You do not have to manage it manually. The technology handles it for you. Another key element of this new age is data-driven decision-making. In the past, investors relied on limited information. Today, data is everywhere. Market trends, economic indicators, and historical patterns are all available. But having data is not enough. The real power comes from using it effectively. Robo-systems are designed to do exactly that. They process information quickly and turn it into actionable strategies. This reduces guesswork. It replaces opinions with evidence, and it creates a more reliable approach to investing. However, it is important to understand that no system is perfect. Markets can still be unpredictable. There will always be ups and downs. The goal of the new age of investing is not to eliminate risk completely, it is to manage it wisely. It is to create a balance between growth and safety. Patience becomes your greatest ally in this journey. Charlie Munger once said that the big money is not in the buying or selling, but in the waiting. This idea is more relevant than ever. With automated systems, you are encouraged to stay invested. You are less likely to react to short-term noise. You are more likely to focus on long-term results. This mindset shift is powerful. It changes the way you see investing. It moves you away from quick wins and towards steady growth. Another benefit of this new age is time freedom. You do not need to spend hours analyzing the market. You do not need to follow every news update. The system works in the background while you focus on your life. This makes investing more accessible for people with busy schedules. It removes one of the biggest barriers that kept many people away. As technology continues to evolve, this trend will only grow stronger. Artificial intelligence will become more advanced. Data analysis will become more accurate, and investing will become even more efficient. Steve Jobs once said that innovation distinguishes between a leader and a follower. The new age of investing is an example of this innovation. It is leading the way toward a smarter approach to wealth building. But while technology provides the tools, you still provide the direction. Your goals, your discipline, and your mindset remain important. The system supports you, but it does not replace you. Understanding this balance is key. You are not giving up control. You are improving the way you use control. As you move forward in this journey, remember that investing is not about perfection. It is about progress. It is about making better decisions over time. The new age of investing gives you the opportunity to do that. It gives you tools that were not available before. It gives you a path that is simple, structured, and effective. Now that you understand this shift, now that you see how technology is changing the game, it is time to go deeper. In the next chapter, you will learn what robo-investing truly is. You will see how it works in practical terms, and you will begin to understand how it can fit into your life. The journey has just begun. Chapter 2. What is robo-investing? Robo-investing may sound complex at first. The word itself can create an image of machines making mysterious decisions, but in reality it is simple and practical. It is a way of investing where technology helps manage your money based on clear rules. At its core, robo-investing is about automation. It uses software systems to invest your money according to a plan. This plan is built around your goals, your risk level, and your time horizon. Once the system is set, it continues to work without constant input from you. Think of it like a smart assistant for your investments. It does not guess or follow emotions. It follows a structured process. It makes decisions based on data and predefined strategies. This approach removes one of the biggest challenges in investing. That challenge is human behavior. Daniel Kahneman, a Nobel Prize-winning psychologist, explained that humans often make irrational decisions, especially under uncertainty. In investing, this leads to buying when prices are high and selling when prices are low. This is the opposite of what leads to success. Robo-investing helps correct this pattern. It creates discipline through automation. It ensures that your investment decisions are consistent and logical. To understand robo-investing better, it is useful to break it into simple steps. First, the system asks you a few questions. These questions are about your goals, your income, your time frame, and your comfort with risk. Based on your answers, the system builds a personalized investment plan. This plan is not random. It is based on financial principles that have been tested over time. It focuses on diversification, long-term growth, and risk management. Second, the system selects investments for you. These are usually a mix of different assets such as stocks and bonds. The goal is to create balance. Some assets provide growth while others provide stability. This mix is often called a portfolio. A well-designed portfolio reduces risk while maintaining the potential for returns. Harry Markowitz, who developed modern portfolio theory, showed that combining different assets can improve results. His idea forms the foundation of many robo-investing systems today. Third, the system manages your investments automatically. It buys and sells assets when needed. It adjusts your portfolio to maintain the right balance. This process is called rebalancing. Rebalancing is important because markets do not move evenly. Some investments grow faster than others. Over time, this can change the balance of your portfolio. The system corrects this without requiring your attention. Fourth, the system invests regularly. This is known as systematic investing. Instead of trying to predict the perfect time, it invests at regular intervals. This approach reduces the impact of market volatility. It also takes advantage of price fluctuations. Sometimes you buy at higher prices and sometimes at lower prices. Over time, this can lead to a balanced average cost. Peter Lynch once said that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. Robo-investing follows this wisdom by focusing on consistency instead of prediction. Another important feature of robo-investing is cost efficiency. Traditional investment management often involves higher fees. These fees can reduce your overall returns. Robo-platforms usually operate at lower costs. They use automation instead of manual management. This means more of your money stays invested and continues to grow. John Bogle emphasized that costs matter greatly in investing. Even small fees can have a big impact over time. Lower costs give you a better chance of long-term success. Transparency is also a key advantage. You can see how your money is being invested. You can track your progress easily. There are no hidden decisions or unclear strategies. This builds trust and confidence. You understand what is happening with your money, and you can make informed choices if needed. Robo-investing is also accessible. You do not need to be an expert to start. You do not need a large amount of money. The barriers that once existed are now much lower. This makes investing available to a wider group of people. It allows more individuals to participate in wealth building. But it is important to remember that robo-investing is not a magic solution. It does not guarantee profits. Markets will still go up and down. The real value lies in its approach. It encourages discipline, patience, and long-term thinking. It helps you avoid common mistakes. It also frees up your time. You do not need to monitor the market constantly. You do not need to react to every piece of news. The system handles the routine tasks for you. This allows you to focus on your life while your investments continue to grow in the background. As technology advances, robo-investing will continue to improve. Artificial intelligence will make systems smarter. Data analysis will become more accurate, and strategies will become more refined. Elon Musk once said that the pace of innovation is increasing rapidly. This is true in the world of investing as well. However, the core principles will remain the same. Diversification, discipline, and patience will always be important. Technology simply helps you apply these principles more effectively. It is also worth noting that robo-investing and human advice can work together. Some people prefer a hybrid approach. They use technology for routine management and seek human guidance for complex decisions. There is no single right way. The best approach is the one that fits your needs and your comfort level. Understanding robo-investing is the first step. Once you see how it works, you begin to realize its potential. It simplifies investing without removing its power. It creates a system that supports your financial journey. It helps you stay on track even when the market becomes uncertain. As you continue reading, you will explore deeper aspects of this approach. You will learn why technology often outperforms emotional decision-making. You will see how it brings efficiency and clarity to investing. The next chapter will take you further into this idea. It will explain why technology has an advantage in managing money, and how this advantage can work in your favor. The journey into smarter investing continues. Chapter 3. Why technology wins. Technology has changed many parts of our lives. It has changed how we communicate, how we work, and how we learn. Now, it is changing how we invest. This change is not temporary. It is a lasting shift that is shaping the future of money. To understand why technology wins in investing, we must first understand human limitations. Humans are intelligent but not always rational. We are influenced by emotions, experiences, and biases. These factors can affect our decisions, especially when money is involved. When markets rise, people feel confident. They believe the growth will continue forever. They invest more often without careful thinking. This is driven by excitement and optimism. When markets fall, fear takes control. People rush to sell to avoid further losses. They forget their long-term plans. They focus only on short-term pain. This cycle repeats again and again. It is one of the main reasons many investors struggle. Howard Marks once said that successful investing is about controlling emotions. But controlling emotions is not easy. It requires discipline and experience. Even experienced investors can make mistakes. Technology approaches investing differently. It does not feel fear or excitement. It does not react to news or rumors. It follows logic and structured rules. This is one of its greatest strengths. It creates consistency in decision-making. It removes the influence of emotional swings. Consistency is important because investing is a long-term process. Short-term movements can be unpredictable, but long-term trends are often more stable. Technology focuses on these long-term trends. It ignores short-term noise. It sticks to the plan even during uncertainty. Another advantage of technology is speed. Humans need time to process information. Technology can analyze large amounts of data in seconds. It can review market trends, economic signals, and historical patterns quickly. It can identify opportunities that may not be visible to human investors. This speed does not mean rushing decisions. It means making informed decisions efficiently. In the modern world, data is everywhere. There is more information available than ever before, but too much information can be overwhelming. Humans can struggle to filter and interpret large data sets. Technology is designed to handle this challenge. It can organize, analyze, and use data effectively. This leads to better decision-making. It reduces reliance on guesswork and opinions. Another key strength of technology is discipline. Once a system is set, it follows the rules consistently. It does not skip steps. It does not change strategy based on mood. This discipline helps maintain balance in your investments. It ensures that your portfolio stays aligned with your goals. For example, when certain investments grow faster than others, the balance can shift. Technology automatically adjusts this balance. This process keeps your risk level under control. Humans often delay or ignore such adjustments. This can lead to increased risk over time. Technology also supports regular investing. It ensures that money is invested at fixed intervals. This removes the need to decide when to invest. Timing the market is one of the most difficult tasks. Even professionals find it challenging. As Peter Lynch said, the real key to making money in stocks is not to get scared out of them. Technology helps you stay invested. It prevents emotional reactions that lead to poor timing. Cost efficiency is another area where technology wins. Traditional investing often involves higher fees. These fees can reduce long-term returns. Automated systems operate at lower costs. They reduce the need for manual intervention. This allows more of your money to remain invested. Over time, this difference can be significant. Small savings in costs can lead to large gains in the future. Technology also increases accessibility. In the past, investing tools were limited to a few people. Today, they are available to almost anyone with internet access. This opens opportunities for more people to build wealth. It creates a more inclusive financial system. Transparency is another benefit. You can see how your money is being managed. You can track performance and understand your portfolio. This clarity builds confidence. It helps you stay committed to your plan. However, it is important to understand that technology is not perfect. It follows the rules that are programmed into it. If the strategy is flawed, the results may not be ideal. This is why choosing the right system is important. You must understand the principles behind it. You must ensure it aligns with your goals. Technology is a tool, not a replacement for thinking. It supports your decisions but does not eliminate responsibility. Another important point is adaptability. Markets change over time. New trends emerge and old patterns may shift. Advanced systems are designed to adapt. They learn from new data. They adjust strategies when needed. This ability to evolve makes technology even more powerful. Satya Nadella once said that every company is becoming a software company. In the same way, every investor is becoming a technology-supported investor. This does not mean human insight is no longer valuable. It means human insight is enhanced by technology. The combination of human understanding and technological efficiency creates a strong advantage. As you continue your journey, you will see how this advantage plays out in real situations. You will understand how technology helps manage risk. You will see how it supports long-term growth. The key idea is simple. Technology wins because it brings consistency, speed, discipline, and efficiency. It removes emotional errors and improves decision-making. But it works best when you use it wisely, when you combine it with clear goals and a patient mindset. The future of investing is not about choosing between humans and machines. It is about using the strengths of both. As you move to the next chapter, you will explore how to begin your journey. You will learn how small steps can lead to meaningful progress, and how starting early can make a big difference over time. The path forward is simple, and it begins with a single step. Chapter 4. Starting with small steps. Every great journey begins with a small step. This idea is simple but often ignored. Many people delay investing because they believe they need a large amount of money. They wait for the perfect time or the perfect situation. But that perfect moment rarely comes. The truth is, you do not need to start big. You only need to start. Small beginnings are powerful because they create momentum. They turn ideas into action. They build habits that grow stronger over time. In investing, the size of your first step is not as important as the consistency of your steps. A small amount invested regularly can grow into something meaningful. This is the quiet power of compounding. As Lao Tzu once said, a journey of 1,000 miles begins with a single step. This wisdom applies perfectly to investing. When you start small, you reduce fear. Large decisions often create hesitation. Small decisions feel manageable. They are easier to take and easier to repeat. This is important because fear is one of the biggest barriers in investing. People worry about losing money. They worry about making mistakes. They worry about not knowing enough. Starting small helps you move past these fears. It allows you to learn without taking large risks. It gives you the confidence to continue. Another advantage of starting small is learning through experience. Reading and studying are helpful, but real understanding comes from doing. When you invest even a small amount, you begin to see how markets move. You notice how your investments change over time. You learn how to stay calm during ups and downs. This experience is valuable. It builds your investing mindset. It prepares you for larger decisions in the future. Robo-investing makes this process even easier. It allows you to start with small amounts. It automates the process so you do not need to make constant decisions. You can set a fixed amount to invest regularly. The system will handle the rest. This creates a habit of investing without requiring effort each time. Habits are powerful because they shape your future. Good habits lead to good outcomes. Investing regularly becomes part of your routine. James Clear has often spoken about the power of small habits. He explains that small improvements repeated over time lead to remarkable results. This principle applies directly to investing. When you invest small amounts consistently, you are building a habit of wealth creation. Each contribution may seem small, but together, they create momentum. Over time, this momentum grows. Your investments start to generate returns. Those returns begin to generate their own returns. This is the compounding effect in action. At first, the growth may seem slow. You may not notice significant changes, but patience is key. As time passes, the growth becomes more visible. What started as small steps turns into meaningful progress. This is why starting early is important. Time is one of the most valuable assets in investing. The earlier you start, the more time your money has to grow. Even a small delay can make a difference. Because compounding works best over long periods. Warren Buffett began investing at a very young age. He often emphasizes that time played a major role in his success. He allowed his investments to grow over decades. You do not need decades of experience to begin. You only need the willingness to take the first step. Another important idea is affordability. Your investments should not create financial stress. You should invest an amount that fits comfortably within your budget. This ensures that you can continue investing consistently. It prevents you from stopping during difficult times. Consistency is more important than size. A smaller amount invested regularly is better than a large amount invested once and then stopped. Robo-investing supports this approach. It encourages regular contributions. It removes the need to decide each time. This reduces decision fatigue. You do not need to think about whether to invest or not. The system does it for you. This simple structure helps you stay on track. Another benefit of starting small is flexibility. As your income grows, you can increase your investments. You can adjust your plan based on your goals. Your journey evolves with you. It is also important to understand that mistakes are part of learning. When you start small, any mistakes you make are also small. This reduces the impact and allows you to learn safely. Instead of fearing mistakes, you can use them as lessons. Each experience helps you improve your understanding. Over time, you become more confident. You develop a clearer view of your financial goals. You make better decisions. Starting small also removes the pressure of perfection. You do not need to know everything before you begin. You do not need to make the perfect choice. You only need to take action. Perfection often leads to delay. Action leads to progress. Another key idea is simplicity. Complex strategies can be confusing. They can lead to inaction. Starting with a simple approach makes it easier to stay consistent. Robo-investing is designed with simplicity in mind. It provides a clear and structured path. You do not need to analyze every market movement. You do not need to follow every news update. The system handles these details. This allows you to focus on your long-term goals. As you continue investing, you will begin to see patterns. You will understand how markets behave over time. You will become more comfortable with fluctuations. This comfort is important. It helps you stay calm during market changes. Market ups and downs are normal. They are part of the investing journey. Starting small helps you experience these changes without panic. It builds emotional strength. This emotional strength is one of the most valuable skills in investing. Many people fail not because of lack of knowledge, but because of emotional reactions. They panic during declines and act impulsively. By starting small, you train yourself to remain steady. You learn to trust the process. This trust grows over time. Another advantage is accessibility. You do not need special skills or connections. Technology has made investing available to almost everyone. You can begin from anywhere. You only need a willingness to learn and take action. This is one of the most positive changes in the financial world. It gives more people the opportunity to build wealth. As you move forward, remember that progress is more important than speed. You do not need to rush. You need to stay consistent. Small steps taken regularly will always outperform large steps taken occasionally. This principle applies not only to investing, but to many areas of life. Over time, these small steps create a strong foundation. They prepare you for larger opportunities. They build confidence, discipline, and patience. These qualities are essential for long-term success. As you continue your journey, you will see how these small beginnings lead to bigger outcomes. You will understand how consistency and discipline work together. The next chapter will explore an important aspect of investing. It will help you understand risk and how to manage it wisely. Chapter 5. Understanding risk. Risk is a word that often creates fear. Many people hear it and immediately think of loss. They imagine uncertainty, danger, and mistakes. Because of this fear, some people avoid investing completely. But avoiding risk does not remove it. It only changes its form. Keeping money idle may feel safe. But over time, inflation reduces its value. Opportunities are missed. Growth does not happen. So the real question is not how to avoid risk. The real question is how to understand and manage it. Risk is a natural part of investing. It is the price you pay for the possibility of growth. Without risk, there is no reward. As Peter Bernstein once said, risk means more things can happen than will happen. This simple idea shows that uncertainty is always present. The goal of a smart investor is not to eliminate risk. It is to handle it wisely. To understand risk better, we must see its different forms. One common type is market risk. This is the risk that prices will move up and down. Markets do not move in a straight line. They rise, fall, and fluctuate over time. These movements can feel uncomfortable, but they are normal. They are part of how markets work. Another type is inflation risk. This is the risk that your money loses purchasing power. Prices of goods and services increase over time. If your money does not grow, it effectively shrinks in value. There is also emotional risk. This is the risk of making decisions based on fear or excitement. It often leads to buying at the wrong time and selling at the wrong time. Benjamin Graham warned that the investor's biggest enemy is often himself. This is especially true when emotions take control. There is also concentration risk. This happens when too much money is invested in one place. If that investment performs poorly, the impact is large. Diversification helps reduce this risk. Spreading investments across different assets creates balance. Understanding these types of risk is the first step. Managing them is the next. Robo-investing plays an important role here. It is designed to handle risk in a structured way. When you begin, the system asks about your comfort with risk. Some people prefer stability. Others are willing to accept more fluctuation for higher potential returns. Based on your answers, the system builds a portfolio. This portfolio balances growth and safety. For example, a conservative approach may include more stable assets. A growth-focused approach may include more dynamic assets. This balance is important. It ensures that your investments match your personality and goals. If your investments are too risky, you may feel stressed. You may react emotionally during market changes. If your investments are too safe, you may miss growth opportunities. Finding the right balance is key. Howard Marks once said that risk is not what you see on the surface. It is what can happen in the future. This means risk is not always obvious. It requires careful thinking. Robo-systems help by using data and proven strategies. They do not rely on guesswork. They analyze patterns and adjust portfolios accordingly. One important feature is rebalancing. Over time, some investments grow faster than others. This can change the risk level of your portfolio. Rebalancing brings it back to the original plan. It ensures that your risk remains controlled. This happens automatically in robo-investing. You do not need to monitor it constantly. Another key idea is time horizon. Risk changes depending on how long you plan to invest. If your time horizon is long, short-term fluctuations matter less. Markets may rise and fall, but over time they tend to grow. If your time horizon is short, stability becomes more important. You may need to protect your capital. Understanding your time horizon helps you choose the right strategy. Robo-systems consider this when building your portfolio. They align your investments with your timeline. Another important concept is risk tolerance. This is your ability to handle market changes emotionally. Two people with the same financial situation may have different tolerance levels. One may stay calm during declines. The other may feel anxious. There is no right or wrong level. The key is to choose a level you can handle comfortably. If you are constantly worried, you may make impulsive decisions. This can harm your long-term results. Robo-investing helps by keeping your strategy aligned with your tolerance. It reduces the need for emotional decisions. Volatility is another aspect of risk. It refers to how much prices move over time. High volatility means larger swings. Low volatility means more stability. Understanding volatility helps you set expectations. It prepares you for market behavior. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. This highlights the importance of staying calm during volatility. Patience reduces the impact of short-term risk. Another important idea is risk and reward balance. Higher potential returns often come with higher risk. Lower risk usually means lower returns. This balance must match your goals. If your goal is long-term growth, you may accept more risk. If your goal is capital protection, you may choose less risk. Robo-systems help maintain this balance. They adjust allocations based on your preferences. It is also important to avoid overconfidence. Some investors believe they can predict the market. They take unnecessary risks. This often leads to losses. Technology reduces this tendency. It follows structured strategies instead of predictions. This creates a more stable approach. Another benefit of understanding risk is clarity. When you understand what to expect, you are less likely to panic. You see market movements as part of the process. You do not react impulsively. This mindset is powerful. It allows you to stay focused on long-term goals. As you gain experience, your understanding of risk improves. You become more comfortable with uncertainty. You make better decisions. Risk is not something to fear. It is something to respect. It is a natural part of growth. When managed properly, it becomes a tool rather than a threat. Robo-investing provides a structured way to manage risk. It combines data discipline and automation. It helps you stay aligned with your goals. But it is still important to stay informed. Understanding the basics gives you confidence. Confidence leads to better decisions. As you continue your journey, you will see how different strategies reduce risk further. You will learn how diversification plays a key role. The next chapter will explore this concept in detail. It will show how spreading your investments creates strength and stability. Because in investing, balance is everything. Chapter 6. The Power of Diversification. Diversification is one of the most important ideas in investing. It is simple to understand, but powerful in its impact. It means spreading your investments across different areas instead of putting everything in one place. Many people make the mistake of focusing on a single investment. They believe it will perform well and bring strong returns. Sometimes this works, but often it increases risk. If that one investment performs poorly, the loss can be significant. This is why diversification matters. Diversification protects your investments. It creates balance. It reduces the impact of any single loss. As the saying goes, do not put all your eggs in one basket. This idea captures the essence of diversification. When you spread your investments across different assets, you reduce risk. Some investments may go down while others may go up. This balance helps stabilize your overall portfolio. Ray Dalio once said diversification is the most important thing you need to know in investing. This shows how essential this concept is. There are different ways to diversify. One common way is by asset type. This means investing in different categories such as stocks, bonds, and other instruments. Each asset behaves differently. Stocks may offer growth. Bonds may provide stability. By combining them, you create a balanced portfolio. Another way to diversify is by industry. Different industries perform differently at different times. Technology, healthcare, finance, and energy all move in their own cycles. When one industry faces challenges, another may perform well. This reduces overall risk. Geographical diversification is also important. Investing in different regions spreads risk across economies. One country may face slowdown while another grows. This global exposure increases opportunities. Time diversification is another idea. Instead of investing all your money at once, you invest gradually over time. This reduces the risk of entering the market at the wrong moment. This approach is often used in robo-investing. It ensures steady participation in the market. Diversification works because markets are unpredictable. No one can accurately predict which investment will perform best. Even experienced investors make mistakes. By diversifying, you reduce dependence on a single outcome. Harry Markowitz, who introduced modern portfolio theory, showed that combining different assets can improve returns while reducing risk. His work changed the way investors think about portfolios. Robo-investing uses this principle effectively. It builds diversified portfolios automatically. It selects a mix of assets based on your goals and risk level. This removes the need for manual selection. It simplifies the process. Another important benefit of diversification is stability. A diversified portfolio experiences less extreme fluctuations. It does not rise as sharply as a single high-performing asset, but it also does not fall as sharply. This creates a smoother investment journey. Stability helps you stay calm during market changes. It reduces the urge to make impulsive decisions. Emotional stability is important in investing. When your portfolio is balanced, you are less likely to panic. This supports long-term success. Diversification also supports consistent growth. While individual assets may fluctuate, the overall portfolio moves steadily. This steady movement aligns with long-term goals. It is important to understand that diversification does not eliminate risk completely. It reduces risk but does not remove it. Markets can still decline, but the impact is usually less severe. Another key idea is correlation. Some investments move in the same direction. Others move differently. Effective diversification involves combining assets that do not move together. This creates balance. Robo-systems analyze these relationships. They select assets that complement each other. This improves portfolio performance. Rebalancing also plays a role in diversification. Over time, some assets grow faster than others. This can change the balance of your portfolio. Rebalancing brings it back to the desired allocation. This maintains diversification. Robo-investing performs this automatically. You do not need to track it manually. This ensures that your portfolio stays aligned with your plan. Another benefit of diversification is opportunity. By investing in multiple areas, you increase your chances of capturing growth. You are not dependent on a single success. You benefit from different sources of return. This broad exposure strengthens your portfolio. However, diversification should be meaningful. Simply adding many investments is not enough. They should be different in behavior and purpose. They should contribute to balance. Too much diversification can also reduce returns. It can dilute strong performers. The goal is to find the right balance. Robo-systems are designed to achieve this balance. They use data and research to create efficient portfolios. This takes the guesswork out of diversification. Another important aspect is simplicity. You do not need a large number of investments to diversify effectively. A well-chosen mix can provide sufficient balance. Simplicity makes it easier to manage and understand your portfolio. As John Bogle often emphasized, simplicity and low cost are key to successful investing. Diversification supports both ideas. It creates a structured approach that is easy to follow. It reduces unnecessary complexity. Over time, this leads to better results. Diversification also aligns with long-term thinking. It is not about short-term gains. It is about steady growth over time. It helps you stay invested through different market conditions. This consistency is essential for compounding. As you continue your investing journey, you will see how diversification works in real situations. You will notice how it reduces volatility. You will experience how it supports stability. This understanding builds confidence. Confidence helps you stay committed to your plan. In the next chapter, you will explore another important aspect of investing. You will learn about the difference between emotion and logic. You will see how controlling emotions can improve your results. Because in the end, successful investing is not just about strategy. It is also about behavior. Chapter 7. Emotion versus logic. Investing is not only about numbers and data. It is also about human behavior. In many cases, behavior matters more than knowledge. Two people can have the same information. One may succeed while the other may fail. The difference often lies in how they handle their emotions. Emotion is a natural part of being human. We feel excitement when things go well. We feel fear when things go wrong. These reactions are normal in daily life. But in investing, these emotions can become a problem. When markets rise, people feel confident. They see their investments growing. They believe the trend will continue. This confidence can turn into overconfidence. They may invest more without proper thinking. They may ignore risks. They may believe they cannot make mistakes. This is where logic is replaced by emotion. On the other hand, when markets fall, fear takes over. People see losses and become anxious. They worry that the decline will continue. This fear can lead to panic decisions. They may sell their investments at the wrong time. They may abandon their long-term plans. This behavior destroys the power of compounding. Benjamin Graham once said that the investor's biggest enemy is often himself. This highlights the role of emotions in investing. Logic offers a different approach. Logic focuses on facts and long-term goals. It does not react to short-term changes. It follows a structured plan. A logical investor understands that markets move in cycles. There will be ups and downs. These movements are normal. Instead of reacting emotionally, a logical investor stays consistent. They follow their strategy. They trust the process. Robo-investing is built on logic. It removes emotional decision-making. It follows rules and data. When markets rise, it does not become overconfident. When markets fall, it does not panic. It continues to operate based on the plan. This consistency is powerful. As Daniel Kahneman explained, humans are influenced by cognitive biases. These biases affect decision-making. One common bias is loss aversion. People feel the pain of loss more strongly than the pleasure of gain. This leads to fear-based decisions. Another bias is herd behavior. People follow what others are doing. If everyone is buying, they buy. If everyone is selling, they sell. This often leads to poor outcomes. Logic helps overcome these biases. It focuses on long-term value instead of short-term noise. Robo-systems apply this logic automatically. They do not follow the crowd. They follow data-driven strategies. This reduces the influence of bias. Another important concept is discipline. Discipline means sticking to your plan even when it is difficult. Emotions often challenge discipline. Fear and excitement create pressure to act. Logic supports discipline. It reminds you of your goals. It keeps you focused on the bigger picture. Warren Buffett is known for his calm approach to investing. He does not react to short-term market movements. He focuses on long-term value. He once said, "Be fearful when others are greedy and greedy when others are fearful." This reflects logical thinking over emotional reaction. Robo-investing follows a similar principle. It does not chase trends. It does not react to market noise. It maintains balance and consistency. Another benefit of logic is clarity. When you follow a logical plan, you know what to expect. You understand your strategy. This reduces uncertainty. When uncertainty is reduced, emotions become easier to control. Education also plays a role. Understanding how markets work builds confidence. Confidence reduces fear. The more you understand, the less likely you are to panic. Robo-investing supports this by simplifying complex processes. It provides clear structures. It shows how your money is being managed. This transparency builds trust. Trust helps you stay committed to your plan. Another key idea is patience. Emotions often push for quick results. People want immediate gains. But investing is a long-term journey. Logic understands this. It values time over quick rewards. Charlie Munger once said that the big money is not in the buying or selling, but in the waiting. This highlights the importance of patience. Robo-systems encourage this mindset. They focus on steady growth. They avoid unnecessary changes. This supports long-term success. It is also important to accept that emotions cannot be removed completely. They are part of human nature. The goal is not to eliminate emotions. The goal is to manage them. Robo-investing acts as a support system. It reduces the impact of emotions on decisions. It creates a buffer between your feelings and your actions. This improves decision quality. Another helpful approach is setting clear goals. When you know why you are investing, it becomes easier to stay focused. Goals provide direction. They guide your decisions. When markets change, you can return to your goals. This helps you stay grounded. Logic is strengthened by clarity of purpose. Consistency is another important factor. Regular investing builds confidence. It reduces the need for constant decision-making. This limits the influence of emotions. Over time, consistency becomes a habit. Habits reduce reliance on willpower. They make it easier to stay on track. Robo-investing supports this through automation. It ensures regular contributions. It maintains discipline without effort. This creates a stable investing process. Another key idea is perspective. Short-term market movements can seem significant, but in a long-term view, they are often small fluctuations. Logic focuses on this bigger picture. It understands that temporary changes are part of the journey. This perspective reduces emotional reactions. As you gain experience, you will notice this shift. You will become less reactive. You will become more patient. This is a sign of growth as an investor. Emotion and logic will always exist together. The goal is to let logic lead and emotion follow. Technology helps make this possible. It creates systems that prioritize logic. It supports you in making better decisions. As you move forward, you will explore how consistency strengthens this approach. You will learn how regular investing builds long-term success. Because in the end, successful investing is not about avoiding emotions completely. It is about making sure they do not control your decisions. Chapter 8. The Magic of Consistency. Consistency is one of the most powerful forces in investing. It may not feel exciting, it may not create instant results, but over time it builds something strong and lasting. Many people look for quick success. They search for the perfect investment. They want fast returns and immediate growth. But real wealth is not built that way. It is built slowly through steady actions. Consistency means doing the right thing again and again. It means investing regularly. It means staying committed to your plan. This simple approach can lead to powerful outcomes. As Warren Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." This quote captures the essence of consistency. Planting the tree is the first step. Caring for it regularly allows it to grow. In investing, your regular contributions are like planting seeds. Each investment adds to your future. At first, the growth may seem small. You may not notice much change. This can be discouraging for some people, but this is where patience becomes important. Consistency works quietly. It builds momentum over time. Each small action adds to the previous one. This creates a compounding effect. Compounding means your returns start generating their own returns. Your money begins to grow at an increasing pace, but compounding needs time and consistency. If you stop and start repeatedly, the effect is weakened. Regular investing strengthens compounding. Robo-investing supports this process. It allows you to invest at fixed intervals. It removes the need to decide each time. This reduces hesitation. It ensures that you stay consistent. Consistency also helps manage market fluctuations. Markets do not move in a straight line. They rise and fall over time. If you invest regularly, you buy at different price levels. Sometimes prices are high, sometimes they are low. Over time, this balances your average cost. This approach reduces the pressure of timing the market. As Peter Lynch said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. Consistency removes the need to predict. It focuses on participation. Participation is what drives long-term growth. Another benefit of consistency is discipline. It creates a structured approach to investing. You follow a plan instead of reacting to emotions. Discipline builds confidence. You know that you are taking the right steps. This confidence helps you stay committed during uncertain times. Consistency also reduces stress. You do not need to worry about daily market movements. You do not need to make frequent decisions. The system handles the process for you. This allows you to focus on your life while your investments grow in the background. Another important aspect is habit formation. Consistency turns investing into a habit. Habits are powerful because they require less effort over time. They become automatic. When investing becomes a habit, you are less likely to skip it. James Clear has explained that habits shape our identity. Small actions repeated daily define who we become. Consistent investing builds the identity of a disciplined investor. This identity influences your decisions. It keeps you aligned with your goals. Another advantage of consistency is progress tracking. When you invest regularly, you can see gradual improvement. Each contribution adds to your portfolio. Each period shows growth. This visible progress motivates you to continue. Motivation is important for long-term success. Consistency also protects you from emotional decisions. When you follow a fixed schedule, you are less influenced by market news. You do not change your plan based on short-term events. This reduces the impact of fear and greed. Robo-investing plays a key role here. It automates regular contributions. It maintains your investment schedule. This removes the need for willpower. Willpower can be inconsistent. Automation ensures consistency. Another important idea is gradual improvement. Consistency allows you to learn and improve over time. You gain experience with each step. You become more confident. Your understanding of markets deepens. This growth in knowledge supports better decisions. Consistency also aligns with long-term thinking. It encourages patience. It focuses on steady progress rather than quick wins. Charlie Munger once said that the big money is not in the buying or selling, but in the waiting. Consistency supports this waiting process. It keeps you invested. It allows time to work in your favor. Another benefit is flexibility. You can adjust your contributions as your income changes. If your income increases, you can invest more. If it decreases, you can adjust accordingly. This adaptability makes consistency sustainable. Sustainability is important for long-term success. Consistency is not about perfection. You do not need to invest the same amount every time. You need to stay committed to the process. Even small contributions matter. Over time, these small contributions create significant results. Another key idea is resilience. Consistency helps you stay strong during market downturns. When markets fall, your regular investments continue. You buy at lower prices. This can benefit you when markets recover. This approach turns downturns into opportunities. Without consistency, many investors stop investing during declines. They miss these opportunities. Consistency ensures that you remain active. It keeps your strategy intact. Another important point is focus. Consistency keeps you focused on your goals. You are not distracted by short-term noise. You follow your plan steadily. This focus improves results. As you continue your journey, you will notice the power of consistency. You will see how small actions lead to meaningful progress. You will experience the benefits of discipline and patience. In the next chapter, you will explore another important advantage. You will learn how low costs can improve your returns. Because in investing, even small savings can make a big difference over time. Consistency builds the foundation, and that foundation supports everything that follows. Chapter 9. Low-cost advantage. Cost is one of the most underestimated factors in investing. Many people focus only on returns. They look for the highest growth and the best-performing investments. But they often ignore how much they are paying along the way. This small oversight can make a big difference. Every investment comes with some form of cost. It may be a management fee. It may be a transaction charge. It may be a hidden expense within the system. At first, these costs may seem small. They may look insignificant when viewed in isolation, but over time they accumulate, and when they accumulate, they reduce your overall returns. This is why understanding cost is essential. John Bogle once said that in investing, you get what you do not pay for. This means lower costs often lead to better outcomes. To understand this better, imagine two investors. Both invest the same amount. Both earn similar returns from the market, but one pays higher fees while the other pays lower fees. Over time, the difference becomes clear. The investor with lower costs keeps more of the returns. The investor with higher costs loses a portion of the growth. This difference grows larger as time passes. Cost affects compounding. When fees are deducted, they reduce the amount that continues to grow. This weakens the compounding effect. Compounding works best when more money remains invested. Lower costs support this process. Robo-investing offers a strong advantage in this area. It is designed to be efficient. It reduces the need for manual management. This leads to lower fees compared to traditional methods. Traditional investing often involves multiple layers of cost. There may be advisors, brokers, and management teams. Each layer adds to the overall expense. Robo-systems simplify this structure. They automate many processes. This reduces operational costs. The savings are passed on to the investor. This is one of the reasons robo-investing has become popular. It provides access to professional-level strategies at a lower cost. Another important aspect is transparency. In some traditional systems, costs are not always clear. There may be hidden charges. There may be complex fee structures. This makes it difficult to understand the true cost. Robo-platforms usually offer clear pricing. You can see what you are paying. You understand how fees are applied. This clarity helps you make informed decisions. It also builds trust. Another key idea is simplicity. Lower-cost systems are often simpler. They focus on efficiency rather than complexity. Complex strategies may promise higher returns, but they often come with higher costs. These costs can reduce the actual benefit. Simple strategies combined with low costs often perform better over time. As John Bogle emphasized, simplicity and cost control are key to long-term success. Another benefit of low-cost investing is accessibility. Lower fees make investing more affordable. More people can participate. This supports financial inclusion. It allows individuals from different backgrounds to build wealth. Robo-investing plays a major role in this change. It removes barriers that once limited access. Another important concept is cost awareness. Being aware of costs helps you make better decisions. You begin to evaluate investments not just on returns, but also on expenses. You choose options that offer value. Value is not just about high returns. It is about what you keep after costs. Another factor to consider is long-term impact. Small differences in cost can lead to large differences over time. This is because of compounding. Every small saving continues to grow. Over years and decades, this growth becomes significant. This is why experienced investors pay close attention to costs. They understand that controlling costs is within their control. Market returns may vary, but costs can be managed. Robo-investing helps you manage this effectively. It provides a cost-efficient structure. It reduces unnecessary expenses. This improves your overall investment experience. Another advantage of lower costs is flexibility. You can invest more frequently without worrying about high transaction charges. This supports consistent investing. It aligns with long-term strategies. It also reduces hesitation. You are less likely to delay investing due to cost concerns. This encourages regular participation. Another important point is performance measurement. When costs are low, it becomes easier to evaluate true performance. You can clearly see how your investments are growing. High costs can mask performance. They can make it difficult to understand actual returns. Low-cost structures provide clarity. This clarity improves decision-making. Another benefit is reduced stress. When costs are controlled, you feel more confident. You know that your money is being used efficiently. This confidence supports long-term commitment. It helps you stay focused on your goals. It is also important to avoid unnecessary trading. Frequent buying and selling can increase costs. Robo-systems reduce this behavior. They follow structured strategies. They avoid excessive transactions. This keeps costs low. Another key idea is alignment with goals. Low-cost investing aligns with long-term goals. It focuses on steady growth rather than short-term gains. This approach supports sustainability. Sustainable strategies are more likely to succeed over time. Another important aspect is comparison. When choosing an investment platform, you should compare costs. Look at fees, structures, and transparency. Choose options that offer value and efficiency. Robo-platforms often stand out in this comparison. They provide a balance of cost and performance. As technology continues to evolve, costs may decrease further. Automation will become more efficient. Competition will increase. This will benefit investors. It will make investing even more accessible. However, it is still important to stay aware. Always understand what you are paying. Make informed choices. Cost may seem like a small detail, but it has a powerful impact. It influences your returns, your experience, and your long-term success. By controlling costs, you improve your chances of achieving your goals. Robo-investing provides a clear advantage in this area. It combines efficiency, simplicity, and transparency. It helps you keep more of what you earn. As you move forward, you will explore how investing can be aligned with your personal goals. You will see how clarity of purpose improves decision-making. Because in the end, investing is not just about growing money. It is about growing it in a way that supports your life. Chapter 10. Goal-based investing. Investing without a goal is like traveling without a destination. You may keep moving, but you do not know where you are going. This lack of direction can lead to confusion and poor decisions. Goal-based investing changes this. It gives your money a purpose. It connects your investments to your life. Instead of focusing only on returns, you focus on outcomes. You ask yourself what you want your money to achieve. This shift is powerful. Many people invest with a general idea of growing wealth, but they do not define what that means. They do not set clear objectives. Without clear goals, it is easy to lose focus. It is easy to react to market movements. It is easy to change strategies frequently. Goal-based investing provides clarity. It creates a roadmap. Your goals can be different depending on your life stage. Some people invest for financial independence. Some invest for education. Some invest for buying a home. Some invest for security in later years. Each goal has its own timeline and requirements. Understanding your goals is the first step. Take time to think about what matters to you. Think about your future needs. Think about the lifestyle you want to build. When your goals are clear, your decisions become easier. Robo-investing supports this approach. It begins by asking about your goals. It uses your answers to create a personalized plan. This plan is built around your timeline and risk level. For example, a long-term goal allows for more growth-oriented investments. A short-term goal may require more stability. This alignment is important. It ensures that your investments match your needs. Another important idea is prioritization. You may have multiple goals. Some may be more important than others. Some may require more resources. Prioritizing helps you allocate your investments effectively. You can create separate plans for different goals. This makes tracking progress easier. Clarity reduces confusion. As Stephen Covey once said, begin with the end in mind. This idea applies perfectly to investing. When you know your destination, you can choose the right path. Another key element is measurability. Goals should be clear and specific. Instead of saying you want to grow wealth, you can define a target. You can set a time frame. This makes your goal more tangible. Measurable goals allow you to track progress. You can see how close you are to achieving them. This creates motivation. Motivation helps you stay consistent. Robo-platforms often provide tools to track your progress. You can see how your investments are moving toward your goals. This visual feedback is encouraging. Another benefit of goal-based investing is discipline. When you have a clear purpose, you are less likely to make impulsive decisions. You do not react to short-term market changes. You stay focused on your long-term objective. This discipline improves results. Another important concept is flexibility. Life changes over time. Your goals may evolve. You may adjust your plans based on new circumstances. Goal-based investing allows for this flexibility. You can update your goals. You can modify your strategy. Robo-systems can adapt to these changes. They adjust your portfolio based on updated information. This ensures that your investments remain aligned with your life. Another key idea is time horizon. Each goal has a different time frame. Short-term goals require stability. Long-term goals allow for growth. Understanding this helps you choose the right approach. It also helps you manage expectations. For long-term goals, you can accept short-term fluctuations. For short-term goals, you may prefer lower risk. This balance is essential. Another important aspect is emotional connection. When your investments are linked to meaningful goals, you feel more committed. You are not just investing for numbers. You are investing for your future. This emotional connection strengthens discipline. It helps you stay focused during challenges. Another benefit is clarity in decision-making. When you face choices, you can refer to your goals. You can ask if a decision supports your objective. This simplifies complex situations. Another important idea is progress over perfection. You do not need to achieve your goal immediately. You need to move steadily toward it. Each step counts. Consistency plays a major role here. Regular contributions bring you closer to your goals. Even small amounts matter. Over time, they create meaningful progress. Another advantage of goal-based investing is reduced stress. When you have a clear plan, you feel more confident. You know what you are working toward. This reduces uncertainty. It allows you to stay calm during market changes. Another important factor is review. Goals should be reviewed periodically. This ensures they remain relevant. You can adjust based on changes in your life. Robo-platforms often provide regular updates. They show how your investments are performing. This keeps you informed. It helps you stay engaged with your plan. Another key idea is balance. You may have short-term and long-term goals. Balancing them is important. You should not ignore one for the other. A well-structured plan considers both. Robo-systems can manage this balance. They allocate resources accordingly. This creates a comprehensive strategy. Another important point is patience. Goals take time to achieve. There may be periods of slow progress, but staying consistent leads to results. As Charlie Munger once said, patience is the key to success. Goal-based investing supports patience. It keeps your focus on the long term. Another benefit is accountability. When you define goals, you hold yourself accountable. You are more likely to follow through. This increases commitment. Commitment leads to success. Goal-based investing transforms the way you see money. It turns investing into a purposeful activity. It connects your financial actions to your life goals. It provides direction, clarity, and motivation. Robo-investing enhances this approach. It automates the process. It keeps your strategy aligned with your goals. It reduces the need for constant decisions. This allows you to focus on what truly matters. As you continue your journey, you will explore how global opportunities can expand your investments. You will see how technology allows access to markets around the world. Because in the modern world, your opportunities are no longer limited by location. And with clear goals, you can take full advantage of these opportunities. Chapter 11. Global Opportunities. The world of investing is no longer limited by borders. In the past, most people invested only in their local markets. They depended on the performance of their own economy. Today, this has changed. Technology has connected global markets. It has made it possible to invest across different countries and regions. This creates new opportunities. Global investing allows you to participate in growth beyond your own country. You are not limited to one economy. You can benefit from progress happening around the world. This is important because no single economy leads forever. Different regions grow at different times. One country may experience strong growth. Another may face challenges. By investing globally, you reduce dependence on a single market. This adds strength to your portfolio. As John Templeton once said, the four most dangerous words in investing are, "This time it is different." This reminds us that markets change and no region is always the best. Global diversification helps you adapt to these changes. It spreads risk across different economies. If one region slows down, another may continue to grow. This balance improves stability. Robo-investing makes global exposure easier. It includes international assets in your portfolio. It selects investments from different regions. This happens automatically based on your plan. You do not need to research each country individually. The system handles the complexity. Another benefit of global investing is access to innovation. Different countries lead in different industries. Some regions are strong in technology, others are leaders in manufacturing or healthcare. By investing globally, you gain exposure to these industries. This increases growth potential. Another important factor is currency diversification. When you invest globally, you are exposed to different currencies. Currency values change over time. This can affect returns. While this adds a layer of complexity, it also creates balance. If one currency weakens, another may strengthen. This provides additional diversification. Global investing also allows you to capture emerging opportunities. Developing economies often grow faster than developed ones. They offer potential for higher returns. However, they may also come with higher risk. A balanced global portfolio includes both developed and emerging markets. This combination provides growth and stability. Robo-systems are designed to create this balance. They allocate investments across regions based on data and strategy. This ensures that your portfolio is well diversified globally. Another advantage is resilience. Global exposure helps your portfolio handle economic changes. If one region faces challenges, others may offset the impact. This reduces overall volatility. Resilience is important for long-term investing. It helps you stay invested during uncertain times. Another key idea is opportunity expansion. When you invest globally, you increase your options. You are not limited to a small set of investments. You can explore a wider range of possibilities. This improves your chances of success. Another important aspect is accessibility. Technology has made global investing easier than ever. You can access international markets through a single platform. This removes barriers that existed in the past. It allows more people to benefit from global growth. Robo-investing simplifies this process. It integrates global investments into your portfolio. It manages them efficiently. This reduces complexity. Another key concept is balance between global and local investments. While global exposure is important, local investments also have value. They provide familiarity. They may align with your daily life and understanding. A balanced portfolio includes both. This creates a strong foundation. Another important idea is long-term perspective. Global markets experience cycles just like local markets. There will be periods of growth and periods of decline. Patience is essential. As with any investment strategy, consistency and discipline matter. Robo-systems support this by maintaining your global allocation. They adjust when needed. This ensures that your portfolio stays aligned with your goals. Another benefit is knowledge expansion. Global investing exposes you to different economies and industries. You learn how different markets operate. This broadens your understanding. It makes you a more informed investor. Another key idea is avoiding home bias. Many investors prefer their local market because it feels familiar, but this can limit opportunities. Global investing encourages a broader view. It helps you look beyond your immediate environment. This mindset improves decision-making. Another important aspect is risk management. Different regions respond differently to economic events. By spreading investments, you reduce overall risk. This aligns with the principle of diversification. Another benefit is growth potential. Global markets provide access to expanding industries and new technologies. This supports long-term wealth creation. Another important point is adaptability. The global economy is constantly changing. New opportunities emerge. Old industries evolve. A global portfolio allows you to adapt to these changes. Robo-systems continuously monitor these trends. They adjust allocations when needed. This keeps your portfolio relevant. Another key idea is simplicity through technology. Global investing may seem complex, but automation makes it manageable. You do not need to handle every detail. The system organizes and manages your investments. This allows you to focus on your goals. Another important concept is confidence. When you know your portfolio is diversified globally, you feel more secure. You are not dependent on a single outcome. This confidence helps you stay invested. Another benefit is alignment with modern investing. The world is becoming more connected. Businesses operate globally. Investing should reflect this reality. Global exposure aligns your portfolio with the global economy. As you continue your journey, you will see how global opportunities enhance your strategy. You will experience the benefits of diversification on a larger scale. In the next chapter, you will explore the role of data in investing. You will understand how information drives decisions, because in the digital age, data is one of the most powerful tools available, and when used correctly, it can transform the way you invest. Chapter 12. The role of data. Data is the foundation of modern investing. It is the information that guides decisions. It is the raw material that shapes strategies. In the past, investors had limited access to data. They relied on reports, news, and personal judgment. Decisions were often based on incomplete information. Today, the situation is very different. Data is everywhere. Market prices, economic indicators, company performance, and global trends are all available. This abundance of information has transformed investing. But having data is not enough. The real value lies in how it is used. Data must be organized, analyzed, and interpreted. Without this process, it becomes overwhelming. Humans can struggle with large amounts of information. It is difficult to process everything accurately. This is where technology becomes powerful. Robo-investing systems are designed to handle data efficiently. They collect information from multiple sources. They analyze patterns and trends. They convert raw data into actionable insights. This allows for better decision-making. As Peter Drucker once said, "What gets measured gets managed." Data allows you to measure performance. It helps you understand what is working and what is not. This understanding improves your strategy. One of the key roles of data is identifying trends. Markets move based on various factors. Economic growth, interest rates, and global events all play a role. Data helps detect these movements. It provides signals that guide investment decisions. Another important use of data is risk management. By analyzing historical patterns, systems can estimate potential risks. They can adjust portfolios to reduce exposure. This creates a more balanced approach. Robo-systems use data to maintain this balance. They monitor your portfolio continuously. They make adjustments when needed. This ensures that your investments remain aligned with your goals. Another key concept is predictive analysis. While no system can predict the future with certainty, data can provide insights. It can highlight probabilities and trends. This improves decision-making. It reduces reliance on guesswork. Another important role of data is performance tracking. You can see how your investments are growing. You can evaluate progress toward your goals. This transparency builds confidence. It helps you stay committed to your plan. Robo-platforms provide clear reports. They show your portfolio performance. This makes it easy to understand your financial position. Another advantage of data is consistency. Data-driven decisions are based on rules and evidence. They are not influenced by emotions. This creates a stable investing process. Consistency improves long-term results. Another important aspect is speed. Technology can process data quickly. It can analyze thousands of data points in seconds. This allows for timely adjustments. It improves efficiency. Another key idea is accuracy. Data analysis reduces errors. It provides a clear picture of market conditions. This supports better decisions. However, it is important to understand that data is not perfect. It is based on past information. Markets can change. Unexpected events can occur. This is why data should be used as a guide, not a guarantee. Robo-systems are designed with this understanding. They adapt to new information. They update strategies when needed. This flexibility makes them more effective. Another important concept is data integration. Different types of data are combined to create a complete picture. Market data, economic data, and historical trends are all considered. This comprehensive approach improves decision quality. Another benefit of data is objectivity. Data does not have bias. It presents facts. This helps remove emotional influence. It supports logical thinking. Another key idea is continuous learning. Robo-systems learn from new data. They improve over time. This makes them more efficient. Artificial intelligence plays a role here. It enhances data analysis. It allows systems to identify complex patterns. This increases accuracy. Another important aspect is customization. Data allows for personalized strategies. Your portfolio is built based on your specific needs. This makes investing more relevant. Another benefit is decision support. Data provides clarity. It helps you understand your options. This improves confidence. Another key concept is simplicity through complexity. While data analysis can be complex, the results are presented simply. Robo-platforms simplify information. They make it easy to understand. This accessibility is important. Another important idea is accountability. Data provides evidence of performance. You can evaluate your strategy. You can make informed adjustments. Another benefit is transparency. You can see how decisions are made. This builds trust. Trust is essential for long-term investing. Another key idea is efficiency. Data-driven systems reduce unnecessary actions. They focus on what matters. This improves results. Another important point is awareness. Data keeps you informed about market conditions. It helps you stay updated. This awareness supports better decisions. Another benefit is adaptability. Data allows systems to respond to changes. They adjust strategies when needed. This keeps your portfolio aligned with current conditions. Another key idea is long-term perspective. Data helps you focus on trends rather than short-term noise. This supports patience. Patience is essential for compounding. Another important concept is balance. Data helps maintain balance in your portfolio. It ensures that your investments are aligned with your goals. Robo-investing uses data as its foundation. It combines analysis, automation, and discipline. It creates a structured approach to investing. This reduces complexity. It improves efficiency. It supports long-term success. As you continue your journey, you will explore the importance of patience and time. You will understand how waiting can be one of the most powerful strategies. Because in investing, time is not just a factor. It is a force that shapes outcomes. Chapter 13: Patience and Time. In the world of investing, two forces matter more than most people realize. These forces are patience and time. They are quiet and often overlooked. They do not create excitement or quick results, but they shape the outcome of every investment journey. Many people enter investing with high expectations. They want fast growth. They want immediate results. They look for opportunities that promise quick success, but investing does not work that way. Real wealth is built slowly. It grows over time through consistent effort. Patience is the ability to wait without losing focus. It is the strength to stay committed to your plan. It is the discipline to avoid reacting to short-term changes. Time is what allows your investments to grow. It is the space in which compounding works. Together, patience and time create powerful results. As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. This highlights the importance of staying calm and committed. When you are patient, you allow your investments to develop. You give them the opportunity to grow. When you lack patience, you interrupt this process. You make decisions based on short-term movements. This often leads to poor outcomes. Markets are naturally volatile. They rise and fall over time. These movements can test your patience. During periods of growth, it is easy to feel confident. During periods of decline, it is difficult to stay calm. This is where patience becomes essential. Charlie Munger once said that the big money is not in the buying or selling, but in the waiting. This simple idea explains the role of time in investing. Waiting allows compounding to take effect. Compounding is the process where your returns generate additional returns. It creates exponential growth. But compounding needs time. If you constantly move in and out of investments, you break this process. You lose the benefits of long-term growth. Robo-investing supports patience. It creates a system that encourages long-term thinking. It reduces the need for frequent decisions. It keeps your investments aligned with your goals. This structure helps you stay committed. Another important idea is delayed gratification. This means choosing long-term rewards over short-term satisfaction. In investing, this is critical. Quick gains can be tempting, but they often come with higher risk. Long-term growth is more stable and reliable. Patience allows you to focus on this long-term growth. Another key concept is perspective. Short-term fluctuations can seem significant, but in a long-term view, they are small changes. Understanding this helps you stay calm. You see market movements as part of the journey. This reduces emotional reactions. Time also provides opportunities. Market declines can create buying opportunities. When prices are lower, your regular investments can acquire more value. This can benefit you when markets recover. But to take advantage of this, you need patience. You need to continue investing even during uncertainty. Robo-systems support this behavior. They maintain consistent investing. They do not react to short-term fear. This ensures that you remain active in the market. Another important aspect is resilience. Patience builds resilience. It helps you handle challenges. You learn to stay steady during difficult periods. This resilience improves your decision-making. Another key idea is trust in the process. When you follow a structured plan, you develop trust. You believe in your strategy. This trust supports patience. It helps you stay committed even when results are not immediate. Another important concept is gradual growth. Wealth does not appear suddenly. It builds step by step. Each contribution adds to your progress. Each period of growth strengthens your portfolio. This gradual process may seem slow, but over time it becomes powerful. Another benefit of patience is reduced stress. When you focus on long-term goals, you worry less about daily changes. You do not react to every market movement. This creates a calmer investing experience. Another important point is avoiding overactivity. Many investors believe that frequent action leads to better results. They buy and sell often. This increases costs and reduces efficiency. Patience reduces unnecessary actions. It keeps your strategy simple. Another key idea is alignment with goals. Your goals are long-term. Patience ensures that your actions match your goals. This alignment improves outcomes. Another important concept is learning over time. As you remain invested, you gain experience. You understand market behavior. You become more confident. This knowledge supports better decisions. Another benefit is consistency. Patience allows you to stay consistent. You continue investing regularly. This strengthens compounding. Another key idea is acceptance of uncertainty. Markets are unpredictable. Patience helps you accept this reality. You focus on what you can control. This includes your contributions and your discipline. Another important aspect is long-term vision. Patience keeps your focus on the future. You are not distracted by short-term events. This clarity improves decision-making. Another benefit is emotional control. Patience reduces impulsive reactions. It helps you stay calm. This improves your investing behavior. Another key concept is time as an ally. When you use time effectively, it works in your favor. It allows your investments to grow. It smooths out short-term volatility. It creates opportunities for compounding. Another important idea is starting early. The earlier you start, the more time you have. This increases your potential for growth. Even small amounts can grow significantly over long periods. Another benefit is flexibility. Time allows you to adjust your strategy. You can respond to changes in your life. This adaptability supports long-term success. Another key idea is persistence. Patience requires persistence. You must continue even when progress seems slow. This persistence leads to results. Another important concept is mindset. A patient mindset focuses on long-term success. It values consistency over speed. This mindset improves your approach to investing. Another benefit is clarity. Patience allows you to think clearly. You are not influenced by short-term noise. This supports logical decisions. Another key idea is balance. Patience and time work together. One supports the other. Without time, patience has no effect. Without patience, time is wasted. Together, they create growth. Robo-investing strengthens this relationship. It creates a system that uses time effectively. It supports patience through automation. This combination improves results. As you continue your journey, you will explore how to avoid common mistakes. You will learn how to protect your progress, because while patience and time build wealth, avoiding errors preserves it. And in investing, both are equally important. Chapter 14. Avoiding common mistakes. Investing success is not only about making the right decisions, it is also about avoiding the wrong ones. Many investors lose money not because they lack knowledge. They lose money because of simple and repeated mistakes. Understanding these mistakes can protect your progress. It can save you from unnecessary losses. It can improve your long-term results. One of the most common mistakes is trying to time the market. Many investors believe they can predict when prices will rise or fall. They wait for the perfect moment to buy. They try to sell before prices drop. This sounds logical, but it is extremely difficult. Markets are influenced by many factors. These factors are unpredictable. Even experienced professionals struggle to time the market. Peter Lynch once said, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves." Trying to time the market often leads to missed opportunities. Investors may stay out during periods of growth. They may enter at the wrong time. Consistency is usually more effective than timing. Another common mistake is emotional decision-making. Fear and greed can influence actions. When markets rise, people become greedy. They invest more without proper thinking. When markets fall, fear takes over. They sell to avoid further losses. This behavior leads to buying high and selling low. Robo-investing helps reduce this mistake. It follows a structured plan. It removes emotional reactions. Another mistake is lack of diversification. Some investors put all their money in one investment. This increases risk. If that investment performs poorly, the impact is large. Diversification spreads risk. It protects your portfolio. Another mistake is ignoring costs. High fees can reduce returns. Many investors do not pay attention to expenses. Over time, these costs add up. They reduce the benefits of compounding. Choosing low-cost options improves long-term results. Another common mistake is overtrading. Frequent buying and selling increases costs. It also increases the chance of making errors. Investing should not be about constant action. Patience is often more effective. Another mistake is chasing trends. Investors often follow popular investments. They buy what is currently performing well. By the time they invest, the price may already be high. This increases risk. Successful investing requires independent thinking. Another mistake is lack of a clear plan. Without a plan, decisions become random. Investors react to market movements. This leads to inconsistency. A clear strategy provides direction. Robo-systems create structured plans, sites. This reduces confusion. Another mistake is unrealistic expectations. Some investors expect quick returns. They become disappointed when results take time. This leads to impatience. Investing requires a long-term perspective. Another mistake is ignoring risk. Some investors focus only on potential returns. They do not consider possible losses. Understanding risk is essential. It helps you make balanced decisions. Another common mistake is not staying invested. Some investors enter the market and exit quickly. They react to short-term changes. This interrupts compounding. Staying invested allows growth. Another mistake is lack of consistency. Investing irregularly reduces effectiveness. Regular contributions build momentum. Consistency supports long-term success. Another important mistake is following others blindly. Many investors rely on opinions without understanding them. They follow advice without analysis. This can lead to poor decisions. It is important to understand your investments. Another mistake is neglecting review. Investments should be monitored periodically. Goals and strategies may need adjustment. Ignoring this can lead to misalignment. Robo-platforms provide regular updates. This helps you stay informed. Another mistake is overconfidence. Some investors believe they cannot make mistakes. They take unnecessary risks. This can lead to losses. Humility is important in investing. Another common mistake is lack of patience. Investors expect immediate results. They change strategies too quickly. This reduces effectiveness. Patience allows strategies to work. Another mistake is reacting to news. Markets are influenced by constant information. News can create fear or excitement. Reacting to every update leads to poor decisions. Long-term focus is more important. Another mistake is not aligning investments with goals. Without alignment, decisions lack direction. Goal-based investing provides clarity. Another mistake is ignoring the power of compounding. Some investors underestimate long-term growth. They focus on short-term gains. Understanding compounding changes perspective. Another mistake is complexity. Some investors believe complex strategies are better. This can lead to confusion. Simple strategies are often more effective. Another important mistake is lack of discipline. Discipline keeps you on track. Without it, strategies fail. Robo-investing supports discipline through automation. Another mistake is not learning. Investing requires continuous understanding. Markets evolve. Staying informed improves decisions. Another mistake is giving up too early. Some investors stop after short-term losses. They miss long-term growth. Persistence is essential. Another key idea is awareness. Knowing these mistakes helps you avoid them. It prepares you for challenges. It improves your approach. Robo-investing reduces many of these mistakes. It provides structure, consistency, and discipline. It supports long-term thinking. But understanding these principles is still important. It helps you stay confident. It helps you make better decisions. Avoiding mistakes is as important as making gains. It protects your progress. It ensures that your efforts are not wasted. As you continue your journey, you will explore how automation strengthens discipline. You will see how systems help maintain consistency. Because in investing, success is not about perfection. It is about making fewer mistakes and staying on the right path. Chapter 15: Automation and Discipline. In investing, two qualities play a powerful role in long-term success: These qualities are automation and discipline. They may sound simple, but together, they create a strong foundation. Many investors struggle not because they lack knowledge. They struggle because they cannot stay consistent. They start with good intentions but lose focus over time. This is where discipline becomes important. Discipline means doing what needs to be done even when it is not exciting. It means following a plan without being distracted. It means staying committed during both good times and difficult times. But discipline alone can be challenging. Human behavior is influenced by emotions, habits, and external factors. This is where automation becomes valuable. Automation supports discipline. It creates systems that operate without constant effort. When you automate your investments, you remove the need to make repeated decisions. You set a plan once, and the system follows it consistently. This reduces the chances of missing opportunities. It also reduces the impact of emotions. As James Clear explains, you do not rise to the level of your goals, you fall to the level of your systems. Automation helps build strong systems. In robo-investing, automation is at the core. It manages contributions, allocations, and adjustments. It ensures that your strategy is executed regularly. One of the biggest advantages of automation is consistency. Consistency is difficult to maintain manually. Life becomes busy. Priorities change. It is easy to skip investments. Automation removes this problem. It ensures that your contributions happen on schedule. This builds momentum. Another important benefit is reduced decision fatigue. Making decisions repeatedly can be exhausting. Over time, this leads to inconsistency. Automation simplifies the process. You do not need to decide each time. The system takes care of routine actions. This frees your mental energy. Another key idea is emotional control. Automation creates a barrier between your emotions and your actions. You do not react impulsively to market changes. The system continues to follow the plan. This improves decision quality. Another benefit is efficiency. Automation ensures that tasks are completed accurately. It reduces errors. It improves overall performance. Another important concept is habit formation. Automation helps create consistent habits. When your investments happen automatically, it becomes part of your routine. You do not need to rely on motivation. The system ensures consistency. Over time, this builds a strong investing habit. Another key idea is reliability. Automation ensures that your strategy is followed regardless of external conditions. It works even when you are busy. It works even when you are distracted. This reliability supports long-term success. Another important aspect is discipline reinforcement. Automation reinforces discipline by removing the need for willpower. Willpower can vary. Some days you feel motivated. Other days you do not. Automation eliminates this variation. It keeps your actions consistent. Another benefit is alignment with goals. Automation ensures that your investments remain aligned with your objectives. It follows the plan you have set. This creates a structured approach. Another key concept is time efficiency. Automation saves time. You do not need to monitor every detail. The system handles routine tasks. This allows you to focus on other aspects of your life. Another important idea is adaptability. Modern robo-systems can adjust based on new information. They can rebalance portfolios. They can modify allocations. This ensures that your strategy remains effective. Another benefit is reduced stress. Automation simplifies investing. You do not need to worry about missing actions. This creates peace of mind. Another key idea is long-term focus. Automation supports long-term thinking. It reduces short-term distractions. This keeps your attention on your goals. Another important concept is accountability. When your investments are automated, you are less likely to skip them. This creates accountability. It ensures that you stay committed. Another benefit is scalability. As your income grows, you can increase your automated contributions. This allows your investments to grow with you. Another key idea is simplicity. Automation simplifies complex processes. It makes investing more accessible. This encourages participation. Another important aspect is consistency during volatility. Markets can be unpredictable. Automation ensures that your strategy continues regardless of market conditions. This supports stability. Another benefit is reduced overactivity. Automation limits unnecessary actions. It keeps your strategy focused. This improves efficiency. Another key idea is trust in systems. When you see automation working effectively, you develop trust. This trust supports long-term commitment. Another important concept is discipline as a habit. With automation, discipline becomes automatic. You do not need to force yourself. It becomes part of your routine. Another benefit is progress tracking. Automated systems provide updates. You can see how your investments are growing. This keeps you informed. Another key idea is integration. Automation integrates different aspects of investing. It combines contributions allocation and rebalancing. This creates a seamless process. Another important point is balance between control and automation. You still set your goals and preferences. The system executes them. This balance is important. Another benefit is consistency across time. Automation ensures that your strategy remains stable. It reduces variation. This improves long-term results. Another key idea is resilience. Automation helps you stay consistent during challenging periods. It prevents emotional reactions. This strengthens your approach. Another important concept is long-term discipline. Discipline is not about short bursts of effort. It is about sustained consistency. Automation supports this sustained effort. Another benefit is clarity. Automation simplifies your strategy. It makes it easier to understand. This improves confidence. Another key idea is continuous improvement. Automated systems evolve with new data. They improve over time. This increases effectiveness. Automation and discipline together create a powerful combination. They reduce errors. They improve consistency. They support long-term growth. Robo-investing uses this combination effectively. It provides a structured approach. It simplifies investing. It helps you stay on track. As you continue your journey, you will explore the importance of security and trust. You will learn how to protect your investments, because while growth is important, protection is equally essential, and a strong system ensures both. Chapter 16: Security and Trust. In the world of investing, growth is important. But growth alone is not enough. Your investments must also be protected. Without security, there can be no real confidence. Without trust, there can be no long-term commitment. Security and trust form the foundation of a strong investing system. Many people hesitate to invest because they are unsure about safety. They worry about losing their money. They question whether systems can be trusted. These concerns are natural. Money represents effort, time, and future hopes. Protecting it is essential. In the digital age, investing often happens through online platforms. This makes security even more important. Robo-investing relies on technology. It uses digital systems to manage your money. This raises an important question. How safe is this approach? The answer lies in understanding how modern systems are built. Security in robo-investing is designed at multiple levels. The first level is data protection. Your personal information is stored securely. Advanced encryption is used to protect your data. Encryption converts information into a secure format. It ensures that only authorized systems can access it. This protects your identity and financial details. The second level is account security. Platforms use authentication methods to verify users. This may include passwords, verification codes, and additional layers of protection. These measures prevent unauthorized access. Another important aspect is regulatory compliance. Trusted platforms operate under financial regulations. These regulations ensure that systems follow strict standards. They protect investors from misuse. Choosing a regulated platform increases safety. Another key idea is segregation of funds. Your money is usually kept separate from the platform operations. This means your investments are not mixed with company funds. This separation adds an extra layer of protection. Another important aspect is transparency. Reliable platforms provide clear information. You can see how your money is invested. You can track your portfolio. This visibility builds trust. Trust grows when there is clarity. Another key idea is system reliability. Technology systems are designed to operate consistently. They are tested and monitored regularly. This ensures smooth functioning. Another important concept is risk management within the system. Robo-platforms use strategies to manage investment risk. They diversify portfolios. They rebalance when needed. This protects your investments from extreme changes. Another benefit is reduced human error. Automation reduces mistakes caused by manual actions. This improves accuracy. Another key idea is reputation. Trustworthy platforms build strong reputations over time. They demonstrate reliability. Choosing a platform with a good track record is important. Another important aspect is user awareness. Security is not only about systems. It also involves user behavior. Using strong passwords and being cautious with information improves safety. Awareness plays a role in protection. Another key concept is continuous improvement. Technology evolves. Security systems are updated regularly. This keeps them strong against new challenges. Another benefit is monitoring. Platforms monitor activity to detect unusual behavior. This helps prevent potential threats. Another important idea is backup systems. Reliable platforms have backup mechanisms. These ensure that data is not lost. This adds another layer of security. Another key concept is trust through consistency. When a system performs reliably over time, trust increases. Consistency builds confidence. Another benefit is peace of mind. When you trust the system, you can focus on your goals. You do not worry about safety constantly. This allows you to stay committed. Another important idea is balance between trust and understanding. You should trust the system but also understand how it works. This combination creates confidence. Another key concept is control. Even with automation, you retain control over your investments. You can view your portfolio. You can make adjustments if needed. This control supports trust. Another benefit is simplicity. Clear systems are easier to trust. Complex systems create confusion. Robo-investing focuses on simplicity. This improves transparency. Another important aspect is communication. Reliable platforms provide updates and information. This keeps you informed. Information builds trust. Another key idea is long-term reliability. Security is not a one-time feature. It must be maintained over time. Robo-systems are designed for continuous operation. This ensures ongoing protection. Another benefit is reduced emotional stress. When you trust your system, you feel more secure. You can stay focused on long-term growth. Another important concept is alignment with goals. Secure systems support your financial journey. They protect your progress. Another key idea is resilience. Strong systems can handle challenges. They continue to operate during market changes. This ensures stability. Another benefit is confidence in automation. When you see security measures in place, you feel comfortable using automated systems. This allows you to benefit fully from robo-investing. Another important aspect is informed decision-making. Understanding security features helps you choose the right platform. This improves your experience. Another key idea is responsibility. Both the platform and the investor share responsibility for security. Systems provide protection. Users must follow safe practices. This partnership creates strong security. Another benefit is trust building over time. Trust is not created instantly. It develops through consistent performance. Robo-investing builds trust through reliability and transparency. Another important concept is future readiness. As technology advances, security systems will continue to improve. This ensures that your investments remain protected. Security and trust are essential for long-term success. They create a stable environment for growth. Without them, even the best strategies cannot succeed. Robo-investing combines technology with strong security measures. It provides a safe and reliable platform. This allows you to invest with confidence. As you continue your journey, you will explore the importance of learning. You will see how knowledge enhances your investing approach. Because while systems provide support, understanding strengthens your decisions, and together they create a powerful foundation for success. Chapter 17. Learning along the way. Investing is not a one-time activity. It is a continuous journey of growth and understanding. No matter how advanced technology becomes, learning will always remain important. Robo-investing simplifies many processes. It automates decisions and reduces complexity. But it does not replace knowledge. Learning gives you awareness. It helps you understand what is happening with your money. It builds confidence in your decisions. Without learning, you may follow systems blindly. With learning, you become an informed investor. This difference is important. As Charlie Munger once said, "Go to bed smarter than when you woke up." This idea applies perfectly to investing. Each day you have the opportunity to improve your understanding. Learning does not need to be complicated. You do not need to study complex theories. You can start with simple concepts. Understanding how markets work is a good beginning. Learning about risk diversification and compounding builds a strong foundation. These principles guide your decisions. Another important aspect of learning is experience. Real learning comes from doing. When you invest, you observe how markets behave. You see how your portfolio changes. This practical experience strengthens your knowledge. Robo-investing supports this process. It allows you to participate while reducing complexity. You learn while your investments are managed efficiently. Another key idea is curiosity. Curiosity drives learning. When you ask questions, you gain deeper understanding. Why did the market move? How does diversification help? What affects returns? These questions lead to insights. Another important concept is staying updated. The financial world evolves. New technologies, new strategies, and new opportunities emerge. Staying informed helps you adapt. You do not need to follow every update, but staying aware of major changes is useful. Another benefit of learning is confidence. When you understand your investments, you feel more secure. You are less likely to panic during market changes. Confidence supports discipline. Another key idea is avoiding misinformation. There is a lot of information available. Not all of it is accurate. Learning helps you evaluate sources. It helps you separate facts from opinions. This improves decision-making. Another important aspect is long-term thinking. Learning helps you focus on fundamentals. You understand that investing is a gradual process. This reduces the desire for quick gains. Another key concept is simplicity. Learning helps you see that simple strategies are often effective. Complexity is not always necessary. This clarity improves your approach. Another benefit is adaptability. As you learn, you can adjust your strategy. You can refine your approach based on experience. This flexibility supports growth. Another important idea is discipline through understanding. When you know why you are following a strategy, it becomes easier to stick with it. Understanding strengthens commitment. Another key concept is continuous improvement. Learning is not a one-time event. It is an ongoing process. Each step adds to your knowledge. Over time, this creates expertise. Another benefit is independence. Learning allows you to make your own decisions. You are not fully dependent on others. This gives you control over your financial journey. Another important aspect is combining learning with technology. Robo-investing provides efficiency. Learning provides understanding. Together, they create a balanced approach. Another key idea is patience in learning. Understanding takes time. You do not need to know everything at once. Step-by-step progress is enough. Another benefit is better communication. When you understand investing, you can discuss it confidently. This helps you share knowledge with others. Another important concept is mindset. A learning mindset keeps you open to new ideas. It encourages growth. Another key idea is responsibility. Learning helps you take responsibility for your investments. You become an active participant. Another benefit is clarity. Knowledge removes confusion. It makes investing easier to understand. Another important aspect is alignment with goals. Learning helps you connect your strategy with your objectives. This improves outcomes. Another key concept is awareness of risks. Learning helps you understand potential challenges. This prepares you for uncertainty. Another benefit is confidence during market changes. When you understand market behavior, you remain calm. This supports long-term success. Another important idea is balance. You do not need to become an expert. You need enough knowledge to make informed decisions. Robo-investing handles complexity. Learning supports understanding. This balance is effective. As you continue your journey, remember that learning never stops. Each experience adds to your knowledge. Each step improves your approach. In the next chapter, you will explore the future of investing. You will see how technology continues to evolve. Because the journey of investing is not only about the present, it is also about preparing for what lies ahead. Chapter 18: The Future of Wealth. The world of investing is evolving continuously. What was once complex and limited is now becoming simple and accessible. Technology is shaping this transformation, and this change is only beginning. The future of wealth will be deeply connected with technology. Automation, data, and artificial intelligence will play a larger role. They will make investing more efficient. They will make it more personalized. Robo-investing is an early example of this future. It shows how technology can simplify financial decisions. It demonstrates how systems can manage investments with discipline. But the future will go even further. Artificial intelligence will become more advanced. It will analyze data more accurately. It will identify patterns more effectively. This will improve decision-making. Investing strategies will become more refined. They will adapt faster to changing conditions. This will create better outcomes for investors. Another important trend is accessibility. More people will have access to investing tools. Barriers will continue to decrease. This will allow more individuals to participate in wealth creation. Financial inclusion will grow. This is a positive change. Another key idea is personalization. Future systems will understand individual needs more deeply. They will create strategies tailored to each person. This will improve alignment with goals. Another important concept is integration. Investing will become part of a larger financial system. Saving, spending, and investing will work together seamlessly. This will create a complete financial experience. Another trend is real-time data. Information will be updated continuously. This will improve responsiveness. Systems will adjust quickly to changes. Another key idea is global connectivity. Markets will become more interconnected. Opportunities will expand across borders. Investors will have access to a wider range of assets. This will increase diversification. Another important aspect is education. Technology will provide better learning tools. Investors will have access to knowledge easily. This will improve understanding. Another key concept is transparency. Future systems will provide clear information. Investors will understand how their money is managed. This will build trust. Another benefit is efficiency. Automation will reduce costs further. This will improve returns. Lower costs will make investing more attractive. Another important idea is sustainability. Investing will focus more on long-term impact. Environmental and social factors will gain importance. This will influence investment choices. Another key concept is security. As technology advances, security systems will improve. This will protect investments. Confidence in digital platforms will increase. Another benefit is convenience. Investing will become easier to manage. User-friendly platforms will simplify processes. This will encourage participation. Another important aspect is adaptability. Future systems will learn continuously. They will improve over time. This will enhance performance. Another key idea is collaboration between humans and technology. Technology will support decision-making. Humans will provide direction and goals. This combination will be powerful. As Satya Nadella once said, every company is becoming a software company. In the same way, every investor is becoming a technology-supported investor. Another important concept is long-term thinking. Despite technological changes, the core principles will remain the same. Patience, discipline, and consistency will always matter. Technology will enhance these principles. It will not replace them. Another key idea is opportunity. The future will create new possibilities. Investors who adapt will benefit. Another benefit is empowerment. Individuals will have more control over their financial lives. They will make informed decisions. This will improve financial well-being. Another important aspect is simplicity. Despite advanced technology systems will aim to remain simple. This will make them accessible. Another key concept is trust in innovation. As systems prove their reliability, trust will grow. This will encourage adoption. Another benefit is long-term growth. Technology will support sustainable wealth creation. It will provide tools for consistent investing. Another important idea is preparation. Understanding these trends helps you stay ready. You can adapt to changes. You can take advantage of new opportunities. The future of wealth is not uncertain. It is evolving in a clear direction. Technology will continue to shape investing. Robo-investing is just the beginning. As you move to the final chapter, you will focus on action. You will learn how to apply everything you have learned, because knowledge is valuable, but action is what creates results. And your journey toward financial freedom depends on the steps you take next. Chapter 19. Taking Action. Today, knowledge is powerful, but only when it is used. Understanding investing concepts is important, but real progress begins when you take action. Many people spend time learning. They read books, watch videos, and gather information. But they hesitate when it is time to start. This hesitation can last for years. The problem is not lack of knowledge. The problem is lack of action. Taking action does not mean making a big move. It means taking the first step. That step can be small, but it creates momentum. As Tony Robbins once said, the path to success is to take massive action, but massive action begins with a single step. Starting today is more important than starting perfectly. You do not need to wait for the perfect time. Markets will always change. Conditions will never be perfect. Waiting often leads to missed opportunities. The best time to start is when you are ready to take action. Robo-investing makes this easier. It removes many barriers. You do not need deep expertise. You do not need constant monitoring. You can begin with a simple plan. Another important idea is starting with what you have. You do not need a large amount of money. Small contributions are enough to begin. What matters is consistency. Each step builds on the previous one. Another key concept is commitment. Once you start, you need to stay consistent. Consistency creates results. Without commitment, progress slows down. Automation can support this commitment. It ensures that your investments continue regularly. Another important aspect is overcoming fear. Fear often prevents action. People worry about losses. They worry about making mistakes, but not starting carries its own risk. It means missing growth opportunities. Taking small steps reduces fear. It allows you to learn gradually. Another key idea is clarity. When you have clear goals, it becomes easier to act. You know why you are investing. This motivation drives action. Another important concept is progress over perfection. You do not need to have everything figured out. You can learn as you go. Action leads to improvement. Another benefit of starting is experience. Real understanding comes from doing. You see how your investments behave. You learn how to manage emotions. This experience is valuable. Another key idea is building momentum. Once you start, it becomes easier to continue. Each step creates confidence. Confidence encourages further action. Another important aspect is discipline. Action should be consistent, not random. Following a plan is essential. Robo-systems help maintain this discipline. They automate the process. Another key concept is focus. Avoid distractions. Do not chase trends. Stay aligned with your goals. Another benefit is long-term thinking. Action should support your future, not just the present. This perspective improves decisions. Another important idea is tracking progress. Monitor your investments. See how they are growing. This keeps you motivated. Another key concept is adaptability. You can adjust your strategy as you learn. This flexibility improves results. Another benefit is confidence building. Each action strengthens your belief in the process. This confidence supports consistency. Another important aspect is patience. Results take time. Do not expect immediate outcomes. Stay committed. Another key idea is responsibility. Taking action means taking control of your financial future. You become an active participant. Another benefit is empowerment. You are no longer dependent on chance. You are creating your own path. Another important concept is simplicity. Keep your strategy simple. Avoid unnecessary complexity. This makes it easier to act. Another key idea is avoiding delay. Procrastination is a major barrier. It prevents progress. Taking action today eliminates delay. Another benefit is alignment with goals. Your actions should support your objectives. This ensures meaningful progress. Another important aspect is consistency over intensity. Regular small actions are more effective than occasional large actions. This builds sustainable growth. Another key concept is learning through action. Each step teaches you something new. This improves your understanding. Another benefit is resilience. Action helps you stay engaged even during challenges. This strengthens your approach. Another important idea is building a habit. Consistent action turns investing into a routine. This makes it easier to maintain. Another key concept is long-term commitment. Investing is a journey, not a one-time event. Action keeps you moving forward. As you reach the final chapter, you will reflect on your journey. You will understand how all these principles come together. Because taking action is the bridge between knowledge and results, and the future you want begins with the step you take today. Chapter 20. Your Financial Freedom Journey. Your journey in investing is more than numbers and returns. It is a journey toward freedom. Freedom to make choices. Freedom to live without constant financial stress. Freedom to design your life on your own terms. Financial freedom does not happen overnight. It is built step by step. It is shaped by habits, decisions, and consistency. Throughout this book, you have explored important ideas. You have learned how technology simplifies investing. You have seen how discipline and consistency create growth. You have understood the role of patience and time. Now, all these ideas come together. Your journey begins with awareness. You understand how investing works. You know the importance of starting early. Awareness leads to action. You take the first step. You begin investing. This step may be small, but it is powerful. As you continue your journey, consistency becomes your strength. You invest regularly. You stay committed to your plan. Over time, this builds momentum. Compounding starts to work in your favor. Your money begins to grow. This growth may be slow at first, but with patience, it becomes meaningful. Another important part of this journey is discipline. You follow your strategy. You avoid unnecessary changes. Discipline keeps you on track. Automation supports this discipline. It ensures that your plan is followed consistently. This reduces the impact of emotions. Another key idea is resilience. There will be challenges. Markets will rise and fall. These changes are part of the journey. Resilience helps you stay steady. You do not panic. You do not abandon your plan. You stay focused on your goals. Another important aspect is learning. Your journey is not static. You continue to grow. You gain experience. This knowledge improves your decisions. Another key concept is clarity. You know why you are investing. Your goals guide your actions. This clarity provides direction. Another benefit is confidence. As you see progress, your confidence increases. You trust the process. This trust helps you stay committed. Another important idea is balance. Financial freedom is not only about wealth, it is also about peace of mind. A balanced approach ensures both. Another key concept is simplicity. You do not need complex strategies. Simple, consistent actions are effective. This simplicity makes your journey sustainable. Another benefit is flexibility. Life changes over time. Your strategy can adapt. This keeps your plan relevant. Another important aspect is independence. You are building your own financial path. You are not relying on chance. This independence is empowering. Another key idea is long-term vision. Financial freedom is a long-term goal. It requires patience, but the results are worth it. Another benefit is reduced stress. When your finances are organized, you feel more secure. This improves your quality of life. Another important concept is purpose. Money becomes a tool. It supports your goals. It enhances your life. Another key idea is responsibility. You are in control of your financial future. Your actions shape your outcomes. Another benefit is fulfillment. Achieving your goals brings satisfaction. It reflects your effort and discipline. Another important aspect is consistency over time. Small actions repeated daily create lasting results. This is the essence of wealth building. Another key concept is staying the course. There will be distractions. There will be challenges. But staying committed leads to success. As Warren Buffett once said, someone is sitting in the shade today because someone planted a tree a long time ago. Your journey is that tree. Each step you take is a seed. Each contribution is growth. Over time, it becomes something meaningful. Robo-investing is a tool that supports this journey. It simplifies the process. It provides structure. But the journey is yours. Your discipline, your patience, and your consistency make the difference. As you move forward, remember that financial freedom is not a destination. It is a continuous journey. Each step brings you closer. Each decision shapes your future. Stay focused, stay consistent, and stay patient, because the life you want is built through the actions you take today.